going to look at Module 3 of Chapter 3, where our learning objective is to explain the purpose of journalizing and posting adjusting entries. Now, the need for adjusting entries, as we explained at the end of Module 2, is due to the time period concept and application of the revenue recognition principle and the matching principle. That is the accrual basis of accounting. So these adjusting entries will really be needed to implement the time period concept, the revenue recognition, and the matching principle. Matching principle, revenue recognition concept, and the time period concept. This is the foundation for the accrual basis of accounting. Now, we've already looked at a trial balance, and the trial balance that we looked at in Chapter 2 is generally referred to as the unadjusted trial balance. This is what they call the raw accounting data before ensuring that all revenues and expenses are properly matched. So we apply the time period concept and revenue recognition as well as matching, and we find very often that adjustments are needed to the unadjusted trial balance. If you recall, we had our trial balance from Smart Touch back in a previous discussion, and one of the things I wanted to point out today is that you purchased office supplies during the year. And the problem, of course, is that as you use office supplies every day, you're not going to go in and make journal entries. So you may have to go into the stockroom, count up the supplies you have to determine how much of those supplies are left. And not all of this will remain, and you might have an expense. You might have an expense for supplies that are used. So again, the initial trial balance from the general ledger is unadjusted, and therefore, in order to apply the matching, revenue recognition, and the time period concept, we have to make adjustments. There are some key points we need to discuss regarding adjusting entries. First, as I mentioned, it's very impractical to adjust accounts such as office supplies on a daily basis. Every time someone goes into the supply room, gets a pen, gets a pack of copy paper, or a toner cartridge for a copy machine, it's not going to be recorded at that point. So revenues and expenses are technically not up to date at the end of the accounting period. And of course, adjusting entries are only made at the end of the period. In fact, if we go back to our previous module, salary expense illustration shows you that salaries are paid on Friday, but the accounting period ends on a Wednesday. Therefore, as of Wednesday, you haven't recorded any salary expense. So just think about a computer system that continually cuts checks and records payroll every Friday. What do you do if your end of period, whether it's a month, in our example, the end of October, was on a Wednesday? What do you do if that's the end of your accounting period and you have to record revenues and expenses correctly? You have to accrue salaries for Monday, Tuesday, and Wednesday. Now again, adjusting entries are only made at the end of the accounting period. One of the most important things to remember is adjusting entries are internal events. They do not involve any transactions with external parties. As a result, adjusting entries never involve cash. These are all non-cash adjustments. They are internal events, internal transactions. So let's go back and let's continue to think about that office supplies illustration. Okay, so again, we don't record the usage of office supplies on a daily basis, but we do wait until the end of the period. So back to our trial balance, let's now remember that this is unadjusted. And as I said earlier, this $500 was the original amount of office supplies that you purchased. So, and remember, this is a 2-month period, so that Smart Touch began operations in, this is the unadjusted trial balance. They began operations in October. They bought these supplies, and now at the end of December, it's likely that $500 of supplies no longer exists. So we go in the stock room, we count the supplies on hand, and we'll find out that some of them have been used. Supplies used are going to be an expense, and we have to adjust that account. Now, you have to remember that in many cases, just as we saw with the retained earnings, in many cases, the accounts will reflect the beginning balances or unadjusted balances. In this case, it was the beginning balance because we had nothing coming over from last year. Notice also, at some point, we're going to have to put in a supplies expense for the amount used. And right now, that account is 0. Now, that's an important point because the supplies used up are in fact going to be expenses, and therefore we have to record that in the trial balance even though an account does not exist in the unadjusted trial balance. So you have to create accounts in this case in order to make the adjustments. Now, when we make our adjusting journal entries, we're going to find out that typically they will, again, they'll never affect cash, as I'll tell you again in a second, but they'll generally affect one balance sheet and one income statement account. The balance sheet account, of course, cannot be cash. So the journal entry that you'll make for adjustments will affect a balance sheet account and an income statement account. But again, it never affects cash. So let's say we go to the stock room and we find out that only $400 of supplies remain. And of course, on the trial balance, the supplies had a balance, let's call this a beginning balance, before adjustment of $500. You go out into the stock room and you count up that only $400 remain. So you take a physical count at the end of the year. So the ending balance has to be $400. Therefore, supplies were used. And that's an expense. That has to be expensed. Therefore, in order to make this account balance, an adjustment of $100 expensed is needed. So we have to adjust for $100. And the journal entry we'll make will be a debit to supplies expense and a credit to office supplies. And again, notice that the account supplies expense was opened in the adjustment process. It did not exist prior to the adjustment. Now, there are returning concepts that keep coming back, so that when we think about adjusting entries, they're required to ensure that revenues are recorded in the period in which they are earned and expenses are recorded in the period in which they are incurred. Once again, we're not going to make these entries on a daily basis from a cost-benefit perspective. No one is going to worry in the middle of November that you used 1 toner cartridge or 2 toner cartridges. It's not material enough. So from a cost perspective, it's too costly to have someone to take an inventory every time you want to find out the office supplies that remain. So again, thinking about another example, in a factory, you would not record supplies expense used in a factory, or again, a toner cartridge every time you change it in the copy machine. And it's based on materiality, cost benefit and materiality. So both materiality and a cost benefit perspective would justify waiting to the end of the period to make these adjusting journal entries. Now, usage, physical usage or consumption of resources is one reason why we make adjusting entries. Another reason would be simply with the passage of time. Insurance policies expire as coverage is used up, and depreciation is another type of expense that is based on time. If a car is going to last 5 years, every year, 1/5 of that car is used up or consumed. And in some entries, of course, have to be made at the end of the year simply because they are based on information that's not available. So as I mentioned earlier in some of the modules, you just don't receive your June utility bill until the middle of July. So again, you don't record, not only from a cost-benefit perspective, but you don't record adjustments throughout the year. Again, going back, materiality is one reason, because on a day-to-day basis, these adjustments are not significant enough to influence someone's judgment. So from a cost-benefit perspective, it costs more than the benefit received by making daily adjustments. In addition, time will cause adjustments to take place. So again, it's materiality if you think about it. If you have an insurance policy, every day that goes by, some of that insurance is being used up. However, you don't record the expense because it's not significant. And once again, here you sometimes simply just don't have the information available. So to summarize, adjusting entries are required every time we prepare financial statements. And when you go back, the key points to review regarding adjusting entries is that every adjustment will affect one balance sheet, at least one balance sheet account, one income statement account, and never any cash flow effect. For example, when we made our adjusting entry, debiting supplies expense, for 100 and crediting office supplies. The balance sheet account was office supplies. The income statement account was the supplies expense. And of course, no cash is involved. And again, notice what it says here. It is one balance sheet and one income statement account. Now, there are two categories of adjusting journal entries: accruals and deferrals. And this is based on the accrual basis of accounting. It gives rise to accruals and deferrals. So the two basic categories are deferrals and accruals. Accruals, you can have accrued revenues and accrued expenses. And deferrals are basically your prepaid. Deferrals are where you have cash paid in advance or cash received in advance. If you think about the terminology, you can call it a prepaid expense or a deferred expense. You can call it an unearned revenue or a deferred revenue. In this case, again, you have to think about whether or not cash is paid first or received first, or is cash paid later or received later. And that will help us understand the definitions. When we look at these definitions, an accrual means that an economic event occurs before the cash event. So an example is you have interest earned before cash is received. And a deferral, the economic event, is taking place after the cash event. In other words, cash is paid first. So it's an advance payment of cash or an advance receipt of cash. So for example, insurance paid in advance, or rent. Paid in advance. So the cash event comes first. So on an accrual, economic event is first. Under a deferral, the cash event is first. Oops. Under a deferral, cash event is first. Accrual, again, I'll repeat that. Economic event is first. Now, let's look at the two types of each. There are two types of deferrals, two types of accruals. So let's start with the deferrals. As far as the deferrals are concerned, there are prepaid expenses and unearned revenues. On a prepaid or a deferred cost, it represents a prior cash expenditure that was made, and it's related to a resource or a benefit that you'll receive in the future. And again, you're going to use that in the revenue generating process. So an example would be office supplies paid first, used later as you're in the process of earning revenue. Rent, so you're renting an office, you need the office to generate revenue. You pay rent at the beginning of the month. It's an advance payment. It's a deferral of that cost. An unearned revenue is another example of a deferral. This is a deferred revenue, and that's going to be an advance receipt. And again, here we can call this a deferred revenue as well. Deferred or unearned revenue, and it's an advance receipt, but you have a liability to perform a service or to provide goods. So examples would be here, a prepaid rent, a prepaid insurance policy. Here, we mentioned this, I think, already, that you could have a subscription, or insurance collected in advance. And remember, because you collected in advance, a deferred revenue is not revenue at all. It is a liability. And a deferred cost is not really a cost. It is an asset. Because you expect to get a resource that will be used later. Accruals are a little bit different. Accruals could be more difficult because they are previously unrecorded. Let me go back to the deferrals. Now, deferrals have already been recorded because cash has already been received or paid. Accruals become a little bit more difficult because they have not previously been recorded. No prior event has been recognized. So you have to have experience with these types of transactions. You need to understand that you need knowledge that you've got a bank account, you've got interest that's being accrued. You also have to worry about whether or not you have a utility bill that you haven't received and then you haven't booked anything yet, or you have salaries that have not been paid. So you have performance by a third party, which could be an employee or a contractor. So again, accruals mean you have to keep looking for invoices to come in. You have to anticipate utility usage, etc. Now, let's get involved with a couple of examples. Let's take a look at rent expense, and these are deferrals. So we're going to start with a deferral. And remember, going back to Chapter 2, on December 1st, let's assume that Smart Touch Learning prepaid 3 months rent in advance so that they would debit an asset account called prepaid rent. They would journalize it first in the journal, and then they post it to the ledger. And the original transaction debits prepaid rent, which is deferred rent or deferred cost, and credits cash. The question now becomes, how much asset value remains? We know that from the assumption that the fiscal year end is December 31st. We have January and February of the next year. So from December 1st to December 31st, you've received 1 month of insurance coverage. Now let's cut this off and say that this is 2014. In 2015, you're still going to have coverage for January and February. So you still have $2,000 of future benefit. So that you used up 1/3 and you have 2/3 remaining. So again, the cutoff time period assumption as of December 31st of 2014, you've got usage of $1,000 and you have $2,000 remaining for the future period. So how much of the asset remains? $2,000. How much of the asset is used? $1,000. Now on the unadjusted trial balance, you're still going to see $3,000 of the asset. If you go back to the previous slides, you're going to see that the unadjusted trial balance has prepaid insurance of $3,000. Now that means that we have the right to insurance coverage, or if it's prepaid rent, you have the right for occupancy for those 3 months. So again, you have rent prepaid, you can have insurance prepaid. Let's say 1/3 expires in each year or each month, and the expiration, when it's used, that's when it becomes an expense. So we have to determine the correct amount of the prepaid rent, and to do this, again, we have to come up with an adjusting journal entry, and we know that 1/3 has been used up. And the time period assumption, again, results in the concept that we're using to cut off on December 31st. So 1/3 will be rent expense, and the other 2/3 will be the asset. So in this case, we're going to have a debit to rent expense and a credit to prepaid rent. Now, if you remember, we said that adjusting entries will be, and again, the prepaid rent was $3,000 for 3 months. 1 month passed. So it's 3 months. So it's $1,000 per month. At the end of December 31st, you used up 1 month. The adjusted balance at December 31st is $2,000. The adjusted balance at December 31st is $2,000. That $2,000 will be used up in January and February of next year. So again, in this case, let's go back. This is the asset value, and we said the asset has $2,000 left. Now from the expense side, you're going to have to post that to the rent expense account as well. So if we go up again, you still have to post to both accounts. Here we're posting the asset reduction from the journal to the ledger. And here we're posting the expense from the journal to the ledger. Same thing happens if it's prepaid rent, prepaid insurance. It operates the same way with the passage of time. Another common deferred cost is depreciation. Long-lived tangible assets generate revenue, and these are known as plant assets. Plant assets are another type of deferred cost. Now, you don't think of it that way because they're significant. If you buy a building, you don't think of a building as a prepaid expense, but they actually are longer-term deferred costs. So that when they are acquired, they're paid, and you have an asset. As they're used, expenses are recognized to match with revenue. Okay. So here, the asset is a deferred cost. When it's used up, it's going to be expensed. So it's really very much like a prepaid asset. Again, the deferred cost is expensed as it's used, and realize, of course, that the expense is being matched with the revenues. However, it takes much longer to do so with a plant asset than a typical prepaid expense like prepaid rent or prepaid insurance. At the end of each year, of course, we still have to adjust a long-lived plant or tangible fixed asset for consumption. And this process of adjusting the property, plant, and equipment, or the plant asset, is known as depreciation. And depreciation is defined as the periodic or the systematic allocation of the cost of a tangible plant asset to expenses over the useful life. And notice the terminology, and this is critical. It's an allocation of cost. It's not valuation. So it's a cost allocation to each period to match cost allocation process, and not a process of economic valuation. So it's not valuation. It's not a true value. Even if we call the balance the net book value or the net carrying value of the asset, it is not really an economic value. It's not the fair value. So you're taking the cost, the prepaid cost with the deferred cost of the plant asset, and you're allocating it to be matched with revenues. So you expense it to match with revenues over the useful life. And there's a debit to the expense and credit the plant asset directly for most of the prepaid expenses. So as we did before, we had a debit to rent expense and a credit to prepaid rent. Not the case for plant assets due to their materiality. So plant assets are not reduced directly. As you would in a prepaid rent. When recording depreciation, the debit's made to depreciation expense. However, the credit is made to a contra asset account, which is known as accumulated depreciation. So when we make the adjusting entry, for depreciation, you're going to debit depreciation expense, but the credit is going to go to a contra asset account called accumulated depreciation. Accumulated depreciation. Now, we never debit or credit the asset directly. So the way this would look is that you're going to have an asset, property, plant, and equipment, or a plant asset. And that's going to have a debit balance. That asset is reduced by an accumulated depreciation account, which will have a credit balance. And of course, the expense is to depreciation expense. This is a contra asset. It's an offset. Contra asset. And together, they form the net book value. Net book value, net carrying value, or the net asset value. Now, why do we use the contra asset? I mean, that's an important question. Why don't we credit the asset directly the way we would do for prepaid rent or prepaid insurance? We use the accumulated depreciation account. Again, it is a credit balance account. It does appear on the asset side of the balance sheet. It is going to have a normal credit balance. All right, so that's important. Okay, so we know that accumulated depreciation is a contra asset. It increases by credits and as a normal credit balance. And the credit balance is offset against the asset account on the balance sheet. The only plant asset that typically doesn't depreciate is land. Land, if anything, will actually increase in value. So to summarize, the process of cost allocation, not valuation, but the process of systematically recording or allocating the periodic usage of plant assets to generate revenues is known as depreciation. The journal entry that will be used in the adjustment process is to debit depreciation expense and credit the accumulated depreciation. Land, as we said, does not depreciate. And an important point here, accumulated is a contra asset. It has a credit balance, and it is part of the asset side of the balance sheet. Even though it has a credit balance, it is not a liability. So let's take an example. Assume that Smart Touch on December 2nd received the contribution of furniture from a stockholder with a market value of $18,000. The entry to record the asset is going to debit the asset furniture for $18,000 and credit common stock. Now this is an unusual transaction actually, and you do need that explanation. It would make sense. Normally it would be a debit to furniture, credit to cash, or a debit to furniture, credit to notes payable, so that someone would obviously have, the reason to question this transaction when they see a debit to furniture and a credit to common stock. So the contribution by a stockholder is of physical assets is somewhat unusual, and the explanation is required. Now, at the end of December, Smart Touch is going to need to depreciate this asset because they use it for 1 month. They use the furniture for 1 month, and we're going to assume that the asset has a useful life of 5 years with no scrap or residual value. We expect nothing to be left at the end of the asset's life. And we'll explain that a lot more when we get into chapters that deal with depreciation. We're going to use something known as the straight line method to depreciate this asset. And under the straight line method, we simply take an equal amount of depreciation per year. And in this case, it's cost minus the scrap value over the useful life of the asset. And this asset will be depreciated at a rate of $3,600 per year or $300 per month. And we call this straight line because if we take the year, if we do it on an annual basis, and we plot this out, it's a constant amount every period. So that for each year, we're going to be taking $3,600 per year or $300 per month. And the adjusting journal entry for the 1 month, now again, this is not recorded until December 31st. It is an adjusting entry. It is not going to be on the unadjusted trial balance. So we make the journal entry for the adjustment by debiting depreciation expense and crediting the accumulated depreciation. And if you go back to the unadjusted trial balance, this is a new account that we had to place on the unadjusted trial. It's open in the adjustment process. Now, of course, depreciation expense, the difference between, when we look at the accumulated, the difference between the cost of the asset and its contra account is known, as I mentioned, net book value, net carrying value, or net asset value. So you'd see this with lots of synonyms: net book value, net carrying value, net book value. The contra account is used, we justify it, because, again, depreciation is only an estimate and may be revised, and therefore the only objective information we have is going to be the cost of the asset. So that's why when we look at net book value, I'll just abbreviate that, NBV, net book value, is going to be the original cost minus its contra account, accumulated depreciation. And that cost is preserved by not crediting that asset directly. It's significant, and because of its significance, we want to maintain the historical cost. It's an objective information that we have. And remember the idea that objective information is useful and sometimes maybe not as relevant as market values, but it's a faithful representation of the asset's cost. Again, we can go back, look at canceled checks, we can look at invoices, we can look at notes payable if that was used to finance the operation. In this case, I know was received, or the $18,000 furniture was donated, but that could also be verified. So as a result, we attempt to preserve the historical costs and record the estimates separately. We keep them separate internally, but of course for financial reporting, we have to put them together and we show the net book value. Now, note that accumulated depreciation is a balance sheet account. We've got to go back to some concepts. They keep coming back to us. Income statement accounts are temporary completed cycles. So every month you're going to be charging $300 on the income statement, but on the balance sheet, the accumulated depreciation, the contra asset account, is a cumulative account so that the amounts on the balance sheet keep adding up. So it's cumulative, and therefore each month and each year you keep accumulating the depreciation. So after 3 months, the accumulated depreciation is going to be $900. And if we look at the T accounts, just taking the T account above, after 3 months, it has 900, so that the net book value now of that asset is $17,100. The net book value is $17,100, and or book value, net asset value, whatever you'd like to call it. It's the cost, the historical cost of 18 minus the accumulated depreciation of 9. So the net book value is $17,100, and this appears on the balance sheet. And don't forget that this is one unit. We cannot separate the contra account from the historical cost of the asset. So to summarize, our deferred or prepaid expenses. We have an initial cost or expenditure, and that's our cash outflow. It is recorded on the balance sheet as an asset. When we record an asset on the balance sheet, the term capitalize is often used. So when you increase an asset, we sometimes use the term capitalization. It is deferred, an unexpired cost at this point. It has future service potential. As the asset is used or consumed in operations, it is expensed, and here we're matching with the revenues generated by the use of that asset, and therefore the expense hits the income statement. So prior to the adjustment, assets are overstated and expenses are understated. And of course, by understating expenses, it means that income is overstated as well. And I want you to go back to the accounting equation, because prior to the adjustment, if you overstate the asset, you're also going to overstate equity through income. Income is overstated because an expense was not recorded. And remember, this is prior to adjustment. Prior to the adjustment. The adjusting entry results in a debit to an expense account, a credit to an asset account, or credit the contra account. Contra asset. Accumulated depreciation. And examples, of course, are prepaid expenses like supplies, insurance. The example we had before was prepaid rent. And then, of course, depreciation. The other type of deferred is a deferred revenue. Deferred revenues are also called unearned revenues or deferred credits. Here, unearned revenues arise when a company receives cash in advance of providing services or goods or products being delivered. It means that it's an advance collection. Unearned revenues, as we said, are also called deferred credits or deferred revenues. And the advance payment, again, creates an obligation. So it is a liability to either deliver goods or provide services. So, for example, let's say on December 21st, a law firm engages SmartTouch to provide e-learning services for the next 30 days, and they give them $600 in advance. On the date that they receive this, the original transaction would debit cash and credit unearned revenue. Unearned revenue is a liability account, and it's on the balance sheet with the current liabilities. And as of December 21st, it is $600. Now, the problem, of course, is that when you get to December 31st, you have the unadjusted trial balance showing that same $600. So the liability is recorded when the payment's received, but it has to be adjusted at the end of the accounting period because some of that may have been earned. So SmartTouch collects $600 on December 21st, but they may have been working at the client's location through December 31st. So we assume that between the time that the payment was received and at the end of December, there was 1/3 of that revenue that was earned. So if you collected $600 in advance, and if 1/3 is earned, that means that you have to have $200 of revenue, and the balance, the $400, is still a liability or unearned. Unearned. So to recognize that 1/3 has been earned, the adjusting entry is needed to reduce the liability by $200 and increase service revenue. The liability is paid in a sense by providing the service, and we recognize the revenue at the same time. So the adjusting entry appears as follows. You would debit the unearned revenue, you reduce the liability. On December 31st, you're making an adjustment to the unadjusted trial balance, so the liability goes down and the revenue is increased. This is going to be posted from the journal to the ledger, and at December 31st, the corrected balance of the remaining liability at December 31st, this is the adjusted balance. The unadjusted balance on the 21st of December is $600, but the adjusted balance is $400. And this means, when you look at this $400, it means that 2/3 of the revenue is still unearned, and it's still a liability. We could show you that also in the balance sheet. The service revenue account, incidentally, also has to be posted. So the second part of that posting, we've already posted the debit, and now the corrected balance of service revenue is $200. Now, of course, this adds to the service revenue that's already on the unadjusted trial balance. So let's summarize the unearned or the deferred revenues. Unearned or deferred revenues are collections of cash in advance. Initially, they're recorded on the balance sheet as a liability, unearned revenue. As delivery takes place or a service is provided, revenue is earned, and then it is recognized on the income statement. So notice again, we're back to the basic concepts we mentioned over and over again, that an adjustment involves one balance sheet and one income statement account. Now remember, prior to the adjustment, liabilities are too high, they're overstated, and revenues are understated. The adjusting entry, as you saw, will result in a debit to the liability, reducing the liability account and increasing the revenue account. And again, examples include rent, magazine subscriptions, season tickets collected in advance for the future, or even as we saw with Smart Touch, consulting fees collected in advance, and therefore it's a liability until those services have been provided. Now again, looking at this overstatement and understatement idea, if we go back to the accounting equation, if prior to the adjustment, if a liability is overstated, in order for the balance sheet to balance, revenue is understated. So again, making use of the accounting equation to understand what's going on here. You have too much of a liability, not enough revenue, so when you make the adjustment, you actually make that correction, and you will show the correct amount of the liability on the balance sheet and the correct amount of revenue on the income statement. So let's summarize deferrals in total, so that when you look at the prepayments, now remember, deferrals mean that a cash event comes into play before the economic event. So you have either receiving cash up front or paying cash. So if it's received in advance, it's a liability. If it's paid in advance, it's an asset. Let's just walk through the paid in advance. We said that when you pay something in advance, you record it as an asset. That is a deferral. We sometimes say we capitalize it in the asset account. So let's say you debited your prepaid insurance. We looked at prepaid rent before, earlier in the module. Let's say you prepaid insurance. So you debit the prepaid insurance and credit cash for a 1-year policy. That means that if you have a 1-year policy, and if the policy costs $1,200, it is $100 per month. So if 1 month expires, you debit insurance expense, credit the prepaid. So that, again, you're now expensing the insurance because you had the coverage, and you're matching that with revenue. The benefits are consumed in that case. Now, after you make your adjustment, you debit the insurance expense, showing the proper amount of expense on the income statement to match with revenue, and you credit the prepaid insurance. The proper balance now of the insurance account is $1,100, which, again, you could verify, you could do a logic check, is $100 per month, which is the cost that, or the amount that you paid for the remaining 11 months. The asset value that remains. Now, the other side of we did a rent as a prepaid rent expense. What if you receive rent in advance? Here, you debit cash and you credit unearned rent. The unearned rent is a liability because you owe occupancy for 1 year. In this case, since it's a 1-year rental, you paid $6,000 in advance. It's $500 per month. So as 1 month goes by, you debit unearned rent and credit rent revenue. You reduce the liability because now you have sort of, if you want to use the term paid, you paid or liquidated this liability by allowing someone to occupy an office or occupy a storefront. So as a result, you have now provided the right to use the office, or you allowed someone to occupy a building for that 1 month, and you have discharged your obligation. So the obligation now is reduced by $500. The remaining liability is for future occupancy, and of course for $500 a month times the remaining 11 months is the $5,500 liability that remains. So you have an obligation to allow 11 months occupancy. And then, of course, the rent revenue is recorded as it is earned. So I think the deferrals somehow get a little bit more, I think, tricky. I know the book in the prior slides say that the accruals are a little more tricky because they don't have any documentation, and you may not be aware of them until year end. But the problem with deferrals is that you have to adjust an existing account. So if you look at the accounts at the bottom of this screen, you'll notice that it's probably easier if you look at the T account to determine what asset balance is left and what liability balance remains. Now, let's get to the accruals. And accruals, as you said, may not be as less complex to work with, but they are in fact more difficult in some ways because you can't identify them. And let's start with accrued expenses. Accrued expenses are expenses that are incurred, unpaid, and unrecorded at the end of the accounting period. They're unrecorded either due to the passage of time, that you haven't really kept track of the interest that's earned, or because no information has been received. So accrued expenses are expenses that are incurred, unpaid, no cash, because the economic event comes first, and unrecorded at the end of the accounting period. Now, in the case of accrued expenses, we'll always debit an expense and credit a liability. So these are sometimes called unrecorded liabilities. So you may have borrowed money, interest is accruing, you owe somebody interest, you don't get a separate bill, it just gets added on to the debt, and you have to keep track, and it's an unrecorded liability up to this point. Salary is the same thing. You have people working for you, but you don't pay the salary until the end of the period. And again, you have to make sure that at the end of the period, the unadjusted trial balance is adjusted accordingly. So let's take that salary example. Let's assume that Smart Touch normally pays monthly, and the monthly salary is going to be $2,400. It pays salaries typically half on the 15th of the month and the remainder on the next month, first day of that next month. So essentially, there are going to be 2 pay periods per month and 2 paychecks of $1,200. So that $1,200 will be in the current month and $1,200 would be in the next month. And if you're preparing monthly financial statements, then that $2,400 will always have to be split. Now again, the problem is going to be when the pay periods are going to be falling within the calendar. So if we look at the calendar for 2014, and we see that December 31st falls on a Wednesday. On December 31st, Smart Touch Learning would need to recognize that they owe 1/2 of the salary. In other words, if we look at the calendar for December, we know that they've already paid. So this has been paid. So out of the $2,400, you pay 15th and the first day. So it happens that this is 2015, But on December 31st, you have to accrue the salary for the last half of the month. So on December 31st of 2014, you have to make an adjusting entry. So again, $1,200 is already paid. But you owe $1,200 on December 31st, 2014. So you have to, as of this date, accrue another $1,200 of salaries. So the accrued expenses, again, one balance sheet, one income statement account. To record this, we'll debit salary expense and credit salary payable. And again, the posting is also shown to the T accounts. So to summarize, accrued expenses are incurred before the cash disbursement. So that on the balance sheet, we have to record a liability, but there's no cash flow at this point. And on the income statement, we record the expense. The cash disbursement is only recorded when the salary is actually paid. So here, the liability is recorded on 12/31/14. Here, the expense is recorded on 12/31/14 in our example, but the cash is paid on January, well, we'll have to say January 2nd, 2015, because of the holiday. So prior to the adjustment, we said that accrued expenses are expenses that are actually incurred, so you do owe somebody some money, but they're incurred, however, they're unpaid, so there's a liability, and they're unrecorded, and hence you have to make the adjusting entry, debiting the salary expense and crediting the salary payable. So before the event is recorded, it is unrecorded, and liabilities and expenses are both understated. And the adjustment will always wind up with a debit to an expense account and a credit to a liability account. So again, here we had to debit the salary expense, $1,200, and we credit salaries payable. And on January 2nd of 2015, when we actually pay this off, it's going to be a debit to salary payable and a credit to cash. Now remember, we're not on a cash basis. If we were on a cash basis, this expense would have shown up in the 2015 income statement, but it's not the case. Since we're on the accrual basis, we're going to show the expense in 2014, even though we pay it in 2015. So the key point is that the services were provided through December 31st, even though they're paid in 2015. So on the accrual basis, we have to recognize the expense in the period in which it is incurred. And finally, we'll look at some accrued revenues. Accrued revenues are revenues that are earned but have not been recorded and have not been collected. So an accrued revenue is a revenue that is earned, not billed, and not collected at the end of the accounting period. And by not being billed and not collected, it is clearly not recorded. So it's not yet recorded and not yet billed. Accrued revenues can come from, providing services and not billing the client. They could also come from passive income, such as dividends and interest income. And again, they're earned, not collected, and not recorded because they may not have been billed. So very simply, you have to set up a receivable, an asset account, and a service revenue account. Again, no cash involved. So as an illustration, on December 15th, Smart Touch Learning agrees to perform e-learning services for $1,600. And they do provide the service, and the agreement, again, at this point, is not an accounting transaction, right? You haven't done anything yet, but by the end of the period, they do earn half, and they haven't really billed yet, but at December 31st, they have to recognize the income. So 1/2, or 800, has to be recognized. Okay, so 1/2 of this, or the 800, has to be recognized, and we debit the receivable because it's not collected, and we have to credit the service revenue. So once again, if we look at accrued revenues, we know that these are revenues that are earned, not billed, not recorded till the end of the accounting period. So it's earned in advance of cash receipts. We know that because, again, accruals mean, remember, deferrals are the case where cash is first. So you have either a prepaid rent or you have a rent collected in advance. Here, the earning takes place before the receipt of cash. So in this case, you have a receivable, no cash flow, and you have revenue recognized. So in our example, we have to debit the accounts receivable, and it was for 800, and we credit service revenue. And that's also for 800, and this was done on 12/31/14, December 31st of 2014, when the service was actually performed. Now, when the cash is collected, 2015 on collection, we'll debit cash, assuming no other services are performed, and we credit the accounts receivable. Note clearly that this is the 2015 collection, and it is not going to affect revenues in 2015. Why? Because the service was provided in 2014, and we appropriately match costs with revenues, or we appropriately recognize revenue under the accrual basis when the service is performed. So in the year the service is performed, we accrue the revenue even though we don't collect it until the very next year. So cash basis revenue, there'd be nothing in 2014, and that does not make any sense. Let's think about this one more time because we're just about to leave the accrual basis for now, and we want to make sure, and I want to reinforce this concept. If you understand the accrual basis, you realize that economic activity, services were performed by Smart Touch in 2014. Therefore, we have to accrue the revenue at that point. We have to debit accounts receivable. We have to credit service revenue for the 800, even though it's not collected. Under the cash basis, when you collect, and by the way, let me go back to that. Under the accrual basis, when we collect that receivable, it doesn't affect revenue. So assuming there's no other revenues taking place in 2015, this should make perfect sense. The service was provided in 2014. That's when you recognize the revenue. The service was not provided in 2015, but that's when the cash was collected. It does not affect your revenues of 2015. So revenues are recognized only when the services are performed. And again, prior to that adjustment, it's unrecorded, so both assets and revenues are understated. And of course, you debit the asset account and you credit the revenue account. Now, to summarize accruals, we'll take an example. And again, you've got previously unrecorded events. So none of these events are recorded. If you don't have an expense recorded, you're going to accrue it by debiting an expense and crediting a liability. And then when you pay the liability, you debit the liability and credit cash. In our example, and I'll explain this a little bit more, unearned revenues, we already did this. You provided service. You debit accounts receivable, credit service revenue in the period performed. But then when you collect it, you debit cash and credit the receivable. Notice there's no expense when cash goes out, and there's no revenue when cash goes in. Now, let me go to the whiteboard for a second and just try to explain a couple of things to you. Let's take the service revenue by Smart Touch. So on 12/31/14, and this is the year 2014. They debit accounts receivable for $800 and they credit service revenue. For $800. And that's the end of the year. Revenue is recognized when the service is performed. So the accrual basis is doing its job. It is recognizing revenues when economic activity takes place. In January of 2015, let's say you collect that receivable. And assume no service provided. There's no activity. Debit to cash for $800 and a credit to service revenue for $800. There is no service provided, so there is no revenue recognized. And that's under the accrual basis. So from an economic standpoint, the accrual basis is absolutely correct. If this was a cash basis, once again, even though services are performed here, there'd be no revenue. Because no cash is collected. But here, under the cash basis, in 2015, this is 2014, in 2015, $800 of revenue is recognized. Even though there's no service performed. This makes absolutely no sense. You've got service performed, but no revenue. Here, no service performed and revenues recognized. So this is why cash basis is not permitted under GAAP, and the accrual basis is what we must use under generally accepted accounting principles. All right, now we'll say a little bit more about this throughout the course. We're going to move on to another learning objective. Several learning objectives. They are relatively short, but extremely important. We'll start with our next learning objective by now moving to the next step. What do you do after you have made these adjusting entries? Well, the answer is you have to provide and prepare another adjusted trial balance.